Hi guys, and welcome to part 4 of our lecture on chapter 4. And where we left off in the last part, we were talking about the accounting for inventory, and we'd done the purchases, and then we did the sales entry, which actually consisted of two parts. And I kind of got cut off on just kind of summarizing what all that looks like. So, to refresh your memory of where we left off, we had recorded the two parts of the sale transaction. So, the first part was the revenue side, and that revenue side, again, revenue has to do with providing or selling services. So we're going to use there the sales price. The sales price was $1,000 each, and we sold two monitors. So that's where we get the $2,000 from. Okay, so the revenue side of the transaction is going to be recorded at the selling price. Okay, and then because we always have to match revenues with expenses according to the matching principle, we have to think, what did we use up in order to generate this revenue? Well, what we used up were those monitors. Okay, so that side, the cost of the monitors being used up is what we call cost of goods sold. And for that, we're going to use the cost of the monitors, what we paid for them, what we bought them for. And that was $600 each. So $600 times the two monitors comes out to $1,200. So the expense part of the sales transaction is going to be at cost. And so now let's look at how these entries look on the ledgers. So you see here we have the revenue side of the transaction, which was accounts receivable increasing by $2,000. That's the promise the customers are going to pay us. And then the sales revenue, again here, of $2,000. But then the other part of the entry, which was the expense, has the cost of goods sold, debit of $1,200. And then here is the merchandise inventory credit of $1,200. Now, one very important thing I want to mention about, again, cost versus price and how you know which one to use and what to use when, is that the merchandise inventory must always be recorded at cost. Okay, that's the rule for inventory. It is always recorded at cost. And that is both when we purchase the inventory and when we sell it. Okay, so when we purchase the inventory, if you recall, on September 1st, we had 10 monitors times $600. So $600 was the cost. That's what we bought it for. So you see the debit here of $6,000. This $6,000 represents 10 monitors. Then we sold two monitors. And it's important that when we sell it, we also credit the merchandise account at that same cost of $600. So that's why this entry here is $1,200, 2 times $600. So that when we now calculate the balance in our merchandise inventory account, what it will show us is $4,800, right? The $6,000 that we purchased minus the $1,200 that we sold. And we know that it's right because when we do the math on this $4,800, that represents 8 monitors at, again, the cost of $600. So if you purchase it at cost and then you take it out of your asset at cost, then your ending balance is also going to be at cost, and we will have properly accounted for the number of units, right? By number of units, I mean the number of monitors, right? We started with 10, we sold 2, and now we have 8 left. Okay, so if for some reason you used the selling price here of $1,000, this math wouldn't work out right. Okay, so you always want to make sure that your merchandise inventory account or your inventory account, any ins or outs, whether it's purchase or sale or whatever, that this inventory account, whenever we touch it, it's going to be at cost. Okay, that'll help help you hopefully from making mistakes on which number to use when. Okay, so now that we have talked about the basic entries, I want to show you how all of this flows down into the financial statements. Okay, so the flow is this. It starts out as an asset on our balance sheet. So any inventory that we have that's sitting on our store shelf, hasn't been sold yet, has a future benefit attached to it, right? It's sitting on our shelf because in the future we're going to sell it. That's going to help us make money. Okay, so our asset, we consider inventory to be an asset, so that's why you see it on the balance sheet. Okay, and so what we have here again is that 4,800, which represents the cost. So the 8 remaining units at the cost of $600. Okay, so that remaining inventory, what was left unsold at the end of the month, is what's going to be on our balance sheet. And again, that's because it represents future benefit because we haven't sold it yet. We're going to sell it. Okay, once we sell our inventory, it comes off of the balance sheet, right? It goes away, but it ends up on the income statement as cost of goods sold. So as the goods are sold, they move off of the balance sheet and onto the income statement. Okay, and so if you look at our income statement, what we have here is kind of a summary of that sales entry that you saw, right? We had the revenue side, which was at $2,000, which again represents the 2 monitors that we sold at the selling price of $1,000 each, minus the cost of those goods, which is what we paid for them, which again, the cost was $600 each. So this $1,200 represents the cost of those 2 monitors, how much we bought those 2 monitors for, which comes out to a total of $1,200. Okay. Now, the income statement of a merchandiser is going to look different than the income statement of a service company. Okay. Now, to refresh your memory, the service company income statement was pretty basic. We took our revenues and we subtracted our expenses, and that equals net income. But when you sell inventory, there's some additional information that we would want to know about that process. And so because of that, this account, cost of goods sold, is a special account. Okay, it's an account again that you're only going to see with companies that sell products, sell goods, and it's something that is very important to understand and to know. And we want to know it's not like all of the other expenses. It's not like rent. It's not like insurance. It's not like your employees, because it works the same way as revenue, meaning that the more number of monitors you sell, the more cost of goods sold you're going to have. Okay, it has to be that way, right? If I sell 5 monitors, I'm going to have 5 cost of goods sold. If I sell 10 monitors, I'm going to have 10 cost of goods sold. Whereas rent doesn't really work that way. Like rent is the same no matter if you sell 5 monitors or 10 monitors or 100 monitors, right? And your employees are going to be the same. It's not based on how much you sell. So because of that, we want to know strictly the amount of profit based on just selling those goods without all of those other expenses, without the rent, without the insurance, without our employees. How much money did we make just from the markup, meaning the difference between cost and price? So we refer to that in the business world as markup. Okay, so in this case, it's a markup of $400. Okay, so how much did we make? Well, We have a special term for that, meaning the markup difference between the amount you bought something for and the amount you're selling it for. And that term is what we call gross profit, which you see here, which you see here. It is also sometimes referred to as gross margin. And the reason why, and I'm sure if we've got any sports fans out here, you've probably heard that word margin before. They'll talk about like if two teams are playing against each other, and if the score was really tight, they'll say, oh, they won by a narrow margin, meaning there wasn't very much difference between the two teams. Or they'll say they won by a wide margin. And wide margin means there was a big difference in points between the two teams. Well, we use that same kind of term here when we talk about gross profit or gross margin, meaning how much difference is there between price and cost. Okay, so on the income statement, since that is important information to know, is how big of a gap was there between the price and the cost, we calculate that on our income statement. So you'll see there's an extra step here in the income statement. It's not just revenue minus expenses. Now it's revenues minus a special expense called cost of goods sold. And that gets us to a special subtotal called gross profit. Then from there, we subtract all the other types of expenses, rent, insurance, utilities, salaries, all of that stuff, and then that gets us to our net income. Okay, so this gross profit, again, like I said, is a meaningful number. It tells us what was the profitability of the sales transactions. How much did they make just from the sale of the product, not counting in any of those other types of expenses. Okay, so that's useful information. But again, like I said, that number, the sales revenue, the cost of sales, and the gross profit, that number is going to change depending on the number of items that you sell, right? So if you sell more, obviously you're going to have gross profit, right? So if I sell 100 monitors instead of 2 monitors, obviously this number is going to be higher, okay? But I want to know, despite how many items I sold, just what was the general markup? It's hard to tell that just looking at these numbers. Okay, so one way to pull more information out of the financial statements and make it easier to interpret and to compare two different companies is what we call the gross margin ratio. Okay, and what the gross margin ratio does is it goes, look, I don't care how many monitors you sold. If you sold 2, if you sold 10, if you sold 100. Let's just break down that profit into a percentage rather than a dollar amount. Okay, so this tells us the dollar amount of the profit, but let's break that out into a percentage so that if we sell 10 or 100, we can still analyze it the same way and still compare two different companies, even if one company sold a lot of goods and the other company just sold 10. Okay, so the formula for gross profit is you take gross profit divided by sales revenue. Okay, so in this case, our gross profit is $800, right? And our sales revenue was $2,000. And if you do the math on that, it comes out to 0.40. And if you convert the decimal to a percentage, because usually gross profit or gross margin ratio is expressed as a percentage, we bump the decimal 2 places over, and that comes out to 40%. Okay? So this information right here, again, tells us the margin or the gap between the cost and the price, regardless of how much we sold, right? And so then we can use this number to compare our company to another company, again, regardless of how much they sold. This gross margin ratio allows you to just look at the number quickly and go, okay, this company made 40% on the markup, whereas another company may have made more or less. Okay, and it takes the number of items that you sold kind of out of the equation. Okay, so this is going to be the next ratio that you do for your project, and we're going to discuss it much more in class on Thursday, and also talk about some ways that we can improve the gross margin. If you see that it's kind of low, what can you do about it? And we're going to talk about business strategies like that. So I want you to start kind of thinking about that, but before we can think about those stuff, we got to understand the ratio. So hopefully this helps, and we'll have a great discussion this week. Thanks.